Hello and welcome to our second lesson. I'm happy to have you here, and today we are going to look at 5 category structure in income statement. As always, we will have 5 objectives. Let's have a look together. We are going to look at how does the 5 category structure fundamentally changes income statement presentation and how it is different from what IS1 was offering. What makes the operating category to stand out, and what we mean by saying it's a default category. As a third objective, we'll have a look to investing category to see how this test individually and largely independently applies to decide what can be classified as an investing income or expense. Our fourth objective will be to have a look at financing category and to see what income and expenses fall under here. Our last objective will be to have a look at 2 mandatory subtotals and to see how they shaped the comparability of financial statements, in our case income statement. Let's quickly tackle our first objective and see how this 5 category framework works and why it's so important and revolutionary. As we know, IFRS 18 suggests that all income and expenses should be categorized to one of these 5 categories: operating, investing, financing, income taxes, discontinued operations. Income taxes and discontinued operations were also present under IS1. These 3 categories are completely new and they have a revolutionary approach that we need to examine and see why it's beneficial as our first objective. Under operating category, we will see income and expenses incidental to entities' main core operations. Other than that, here we will also see income and expenses that do not belong to other categories. It's like a default position for income and expenses that we couldn't classify in other 4 categories, and they land here. About this, we'll talk a bit in detail during our second objective, when we will discuss the operating category and why it's also called default. Of course, investors are very much interested to see the operating profit from entities' core operations. That's kind of the most important indicator of healthiness of the business. That's why it's very important for investors also to have this categorization where they can start from operating profit, then move on to investing and financing activities to see how they interact between each other. Second category is our investing category, where we will see income and expenses from assets that generate returns individually and largely independently from other resources. And this we will explore even more when we go to our third objective. And as you see here, we will see income and expenses from investing. Usually we will have here investment property, returns, expenses, or cash balance returns, interest if we earn some returns from our cash balances or some deposits, and so on. Our next category will be financing, and this one is more or less under control of management. Management decides how the company will be financed. And that's why it's very important for investors to see this category completely separate from the other categories, to be able to evaluate how risky is the business or what's the means of financing the company and so on. And here we will see income and expenses from liabilities that serve business to finance the business. We will of course deep dive and see what is